All right, now global oil prices are climbing sharply, raising fresh concerns about the cost of fuel in South Africa. The surge, driven largely by escalating tensions in the Middle East, has pushed crude oil above $100 a barrel. That was a development that could have translated into higher prices at the pumps for South African motorists. Analysts even warn that because the country relies heavily on imported oil, sustained increases in global prices could drive up transport costs, inflation, and even place additional strain on already stretched household budgets. Citigroup Chief Economist Gina Schoeman joining us now for more when it comes to this. Gina, it's a good morning to you. There's so much absolutely going on, but here's my question. Is it justified for us to be having these major concerns now? It's all gone back down to around $90 a barrel has oil. The rand is back at 16.33 odd. Yes, not below 16 again, but it's all sort of tapered down a little bit. Is the cause for concern still supposedly there?
Well, good morning. I guess a good morning because, yes, the prices went below $100 per barrel. There is cause for concern. There always is when the oil price goes up and the currency depreciates because, as mentioned earlier, this puts a lot of strain on petrol prices, which puts a lot of strain on household budgets. Whether you're driving a car or taking public transport, it hurts. The prices will go up. However, we mustn't become too fear-mongering here. The reason the oil price came down somewhat last night was because US President Trump did state that the war would be over relatively soon. And we must also remember that the US themselves are now seeing the effects of higher inflation because of these oil prices. And that will put a lot of pressure on, number one, trying to end the war, and number two, also releasing more reserves into the world so that demand for oil comes down, supply goes up, and therefore the prices can hopefully retreat. So we've done quite a lot of calculations here. I mean, it's never good news, and it won't be good news for this month of March for the petrol price in South Africa. I think the rand-dollar exchange rate has been extraordinarily more contained than usual. And I think that's thanks to South Africa's heavy lifting, not just structural reforms, but also very disciplined monetary policy and fiscal policy. And we have seen before how we do have some measures that we can use temporarily to ease and cushion the impact. So in the Russia-Ukraine oil price surge, we saw that very temporarily, government removed the fuel price levy. Yeah. So that is something that we could do, but we don't want to do that for too long, because that can also then start putting a lot of strain on the budget itself.
Gina, there's also the fact that our strategic oil reserves aren't where they all often used to be in the past. And this might be something that we then sit with and say, well, we haven't kept enough oil as a country as backup anyway. So now we're definitely going to be price takers no matter what the situation is like. Is that the case?
Unfortunately, yes. Our oil reserves are very, very thin. I wouldn't really, put them down too much. And we depend highly on Saudi Arabia, Nigeria, and Angola. Those are our three main places we import from. But this is why it's so important that other countries start using their reserves, or why OPEC starts to release more oil into the market. So the more that, and that's likely to be the case, to get prices a little bit more steady. If the oil price had to drop back to somewhere in the 70s, you would ease a lot of concerns. The currency would hopefully then move slowly back to about the 16 against the dollar, and then we wouldn't have as big an effect. So yes, we are concerned about the fact that we don't have enough reserves, but luckily there are so many countries that have huge oil reserves, and hopefully more of that will be released.
Yeah, because I thought that was the whole point. OPEC Plus had kept on saying that there's a supply glut. We've got so much oil in the market, and that's why oil prices were able to remain at $60, $70 a barrel. And now, yes, they're above 90 because of the shock, but there's still a lot of oil in the market. So staying consistently above 100, no matter what the situation is, if this was to continue for 3 to 6 months or even longer, would that then create a situation where oil prices stay above $100 a barrel, do you think?
Not necessarily above $100 per barrel. We have run scenarios where we've gone temporarily up to $120 per barrel, but then it comes down in the second half of the year in the event the conflict continues and the war continues. If it comes down to it can come down to about $80 per barrel for the rest of the year. Now, that's still not a pretty picture, especially for emerging markets that import a lot of oil and their currencies are somewhat weaker, but it at least eases some of the concerns that we're facing right now. Remember, a lot of the oil price move is not just because of the lack of supply, but it's also because of the speculation around the war and the uncertainty, really, around what's going on. So there is a lot of technical trading taking place here. But one thing I will stress again is that we must remember that while, yes, the gold price has come down somewhat, what is helping South Africa and offsetting the surge in the oil price is still very high metal prices, which has been very supportive of our currency, together with some of the domestic discipline that our government has been showing.
Yeah. Do you have a scenario for what happens if the Strait of Hormuz is taken over by the United States? Because Donald Trump seems to be trying to tout that as a possibility. 20% of the global oil exports go through the Strait of Hormuz.
We haven't run that as a scenario. It's quite politically sensitive to do so. However, if that had to occur, you'd imagine that supply would, freely flow, and therefore we wouldn't be in the situation we were right now. But that doesn't mean it's necessarily a good thing in the long run. It would have longer-term implications. But I think for now, where we're sitting, just to break it down in a very easy, user-friendly way, the rule of thumb is, and this is how it works quite simply with inflation, is that for every increase of $10 per barrel, you're going to see round about R1 per litre increase in your petrol price in South Africa. And that's not taking into account the slight or somewhat of a depreciated or weaker currency into account. But again, we must offset that to a degree by the fact that metals prices are remaining high. So at least we've still got the gold price and precious metals in our favor.
So that means we could see up to R2 increase in fuel next month if we go by that estimate.
Yeah, absolutely. I mean, you could have a scenario where petrol prices jump R4 per litre. But what's really important here is that it only happens for 1 month. And if it happens for only 1 month and it starts to retreat back to more normalized levels, then government has the ability to intervene and perhaps take off the fuel levy for just that 1 month, like they've done in the past. But that is not something that South Africa has the power to do on an ongoing basis. And that's why we've taken off our rate cut view from the South Africa Reserve Bank for March. But we still think that if everything starts to settle down, then you can still see interest rate cuts later on this year.
Yeah, that's actually very interesting. So rate cuts still possible this year, despite this turmoil. Let's talk about why that is. Why is it still possible for us to get a cut in interest rates, which could be good news for a lot of indebted consumers?
No, absolutely. If it's short-lived and this petrol price hike goes up for 1 month and then comes down quite quickly after that, then you're just going to get a short temporary blip in inflation, which the South Africa Reserve Bank MPC often says they look through, and they do look through it. It's more of a problem when it stretches on for longer, because the longer it stretches on for, the more it moves through supply chains through second-round effects. And that's when it moves from just headline CPI to core CPI. And once core CPI starts going up, in other words, retailers, service providers, they're all using fuel in their supply chains. So the more that price gets passed through and the longer it gets passed through from, then you suddenly see more prices in South Africa start to increase. Then it gets sticky and entrenched. And that would take away the prospect of more rate cuts. So if this is short-lived, yes, you could see the SARB saying, well, we're a bit concerned now. Most central banks are, by the way, around the world. So we're just going to take a pause. We're going to wait and see, because inflation is very important to contain, and a rate cut isn't going to help doing that. But don't worry, if this is short-lived, we can look through it, and at the next meeting, we can reconsider it. And the reason being is that if it is short-lived, then inflation in South Africa could very easily be between a 3 and 3.5% handle this year, which allows the South Africa Reserve Bank to cut rates.
Very interesting. Okay, and we have GDP numbers out today. Yes, these won't necessarily look at the figures for this quarter, because interestingly enough, we'll find out how this goes and the impact thereof a little bit later on. But the last 3 months of last year, the anticipation with regards to that, I mean, last year wasn't necessarily that great. We hovered between, what was it, 0.1 and 0.8?
Well, actually, if we correct, and we're very much in line with the consensus, expecting, some very moderate growth on a quarter-on-quarter basis. However, on a year-on-year basis, it is very possible that 2025 GDP growth in South Africa ends up above 1%. And I would say, given that it was almost a tale of two cities, the first half of last year was horrendous for South Africa. Second half of last year was just this beautiful, constructive story. So South Africa did prove to be more resilient. And again, I'll go back to the fact that, we saw a lot of heavy lifting come from reforms, not just structural reforms. So in other words, getting rid of load shedding mostly and some logistical improvement, but also fiscal discipline and monetary policy discipline. So that would be moving to that 3% target. This year, so there is unfortunately a GDP impact if fuel prices continue and oil prices continue at these highs. Another, very rule of thumb we use is that for every $10 per barrel increase in the oil price, but this would have to be for the full year. So if the full year oil price had increased by $10 per barrel, you would shave about 0.1 or to 0.2 percentage points off GDP growth. But as I said, if this is very short-lived and is contained to a surge for 1 or 2 months, then you're going to see Q2 GDP growth this year suffer somewhat, but then it bounces back.
I mean, look, overall, this is a situation that for a much more upbeat finance minister would certainly not appreciate. I mean, in a recent interview, he had been speaking about how South Africa are price takers, right, and would have to suffer at the consequences of a situation like this and take it head on. But are we really turning the corner? According to our own fiscus, if we look at our own financial situation as a country, are we really turning the corner? We've seen a lot of positivity over the last 2 budgets as well, but are we really getting somewhere?
Yes, I believe we are. And what I guess, if you want to keep the glass half full, this is a very good test for the resilience that South Africa has shown and the reduction in what we call the risk premium. So again, it is a good thing that the finance minister came out with those comments because it immediately assures us that they will continue to be very disciplined. In other words, if they have to give a fuel price levy temporary stoppage to the economy to try and cushion the blow, that's going to remove some of their tax revenue. So they're going to have to be even more careful about spending and contain spending even further because they did say that they would stabilize debt in 2025. And that is why bond yields have come down, which is why it's cheaper now to service our public debt. And that's also what has helped inflation come down because of the currency. And then, of course, you've got the South Africa Reserve Bank that is now targeting 3%. So they will, if necessary, not cut interest rates to achieve that 3% because inflation is more important to this economy. It impacts low-income individuals, inflation does, more than interest rate cuts. And we've got far more low-income individuals in this country than we do high-income individuals.
It certainly helps to have a tax man that works as well, right?
Oh, absolutely. No, look, we've got what we call almost the trifecta at the moment. South Africa's been very much the Goldilocks story. We seem to have taken that away from Poland for now in the emerging market space. But that's because growth proved to be resilient last year. There is a potential growth story thanks to the structural reforms from Operation Bodandlela that continue to show progress. It's never a straight line, but they do continue to show progress. I think people are very excited about the municipal service delivery reforms. And all of that helps sentiment and helps to drive private sector fixed investment. But at the same time, complementing that, and this might be the part that wasn't seen coming, is fiscal policy discipline being very consistent over each budget. Even though we went through 3 budgets in Parliament in the first half of last year, that was more of a political ramification because of the GNU and its early days. At no point did anyone ask, no political party asked Treasury to borrow more to solve the problem of the VAT debacle. It was always just a political debate about what to do with revenue and expenditure. And that's very good. That means that we are very disciplined in terms of taking on debt.
Gina, always good chatting to you. Thank you so much. Really appreciate it this morning. A good conversation there around the implications of what we're seeing out of the Middle East on South African consumers, everything from inflation to the price of goods and services, including, of course, fuel costs, which might be in question. Citigroup Chief Economist, Gina Schoeman.